Good morning, good afternoon, good evening. Let's start with the next topic, that is special rules for certain employee. In previous sessions, we have already gone through certain incomes, right? Wages related income we have completed. Now let's see for certain employees, there are some different rules. If you are a clergy, right? What do you mean by clergy? If you are working in a church, right, or any religious institution, right, working for that institutions or working for church, and if you're receiving some income, okay, then in that case all the income which you are receiving, you are going to include it in the income. Any salary, fees received for masses, marriages, baptism, funerals, etc. Okay, payments, if someone is making payment to the religious institution, and being a religious institution you're receiving that payment, that need not be included in the income, in the taxable income. Okay, just the thing is, if you are an employee, you will be called as a clergy, right? So if you're an employee, you're a clergy employee, you're working for the churches and you're receiving the income, then it's taxable for you. Okay, now there is some different rule for the members of religious organization. If you're a member of a religious organization and who gives no outside earnings to the organization, right, they are earning something and then providing that amount to the organization, will be included in the earning as an income, and maybe take a charitable deduction for the amount paid to the organization. Now let me explain you this. If I'm a member, okay, of say XYZ church, okay, I'm doing some activities and earning some income. The whole income, it doesn't matter that the member is going to deposit it to the XYZ church, because I'm the member of that church, I'm going to deposit it to that church. Whole earning will first be taxable to the member, and out of this, whatever amount they are giving it to the church, for that amount they can take a deduction. Okay, they can take a charitable contribution deduction. All right, so this was one concept. First is simply, if you're a clergy, you are going to include everything in your income, whatever you are receiving from the organization. If you are an organization, you are a religious institution, and if you receive something from other people, then you are not going to include it as an income. All right, if you're a member of religious organization, you are performing some activities, earning something from there, and then depositing it to the charitable institution, then first and foremost you are going to include everything in your income, and whatever you are depositing to the church will take it as a charitable donation, as a deduction. Okay, now what happened, the members of the religious organization may have the facility of housing. The housing is provided by the different religious institutions. And second thing is pension. First, if they are providing you the housing services, right, the rental value of the home plus utilities plus designated no housing allowances, this plus is excess. Okay, housing allowances, if you are receiving, then you are not going to include it in your income. Okay, means you're not going to include it in your W2 income, but it will go to your Schedule C. If you are a member of the charitable organization and if you receive the services, these benefits, you are not going to include it in the W2, but you are going to include it in your Schedule C, and you are going to pay a self-employment tax on that. Okay, all right. Next is, if you have a church employee, right, and the income of that church employee is more than $108.28, right, you must pay a self-employment tax. All right. For pension, if you receive it, it will be a normal treatment, right? You are going to receive a pension, and if 1099R you are going to receive, you are going to make it taxable in your 1040 return. Okay, that's it. Next type of employee is a foreign employer. Okay, if I am a foreign employer and providing employment to some resident employees, okay, then in that case is not considered to be the wages for Social Security and Medicare tax purposes. Okay, so if you're working for a foreign employer, right, for a foreign organization, then in that case, whatever wages are being paid by that organization, that you are not going to, have a Social Security and Medicare taxes on that amount. Okay, and that wages are to be considered as a self-employment if income received as a US citizen for an international organization. Okay, let's say I am a US citizen. For example, I am working for other company which is a foreign company, foreign organization. So whatever income I am going to receive from that, for on that income I am not liable to pay Medicare and Social Security taxes or any federal income taxes. So in that case, they are going to issue me 1099 NEC or maybe MISC for the income which I'm earning from their side. And that income, being an individual, I'm going to include it as a Schedule C income, business income. Okay, and on that income, I'm going to pay a self-employment tax. All right, clear about the foreign employers, guys? Next is member of a religious order. Okay, if you're a member of a religious order, and in that case services which you are performing is for the order, right? And the second point is services performed outside the order. If you're performing services within the order, the wages which a member is receiving, which the member is earning as an agent of the order, and then it turns it over to the religious institution, then in that case that amount is not to be included in the income. This is the same case which we did right now over here. Okay, but in this case what is happening, you are a member of a religious organization, and here you are still a member, but you are performing the services in order, within the order. Then in that case, whatever the member is earning and whatever they are going to transfer it to the religious institution, that is not taxable. Okay, service performed for the order. If it's performed for the specific order, then in that case it is not taxable. But if it's performed outside the orders of the religious institution or organization, then it has to be included in the income. It will be treated same as we saw over here. It will be treated as the same. It will be included in the income, and whatever your amount you are transferring, maybe 4%, 5%, whatever amount you are transferring from the total earning, that will be taken as a charitable deduction in your Schedule A. Okay, exception to this rule is services that are ordinarily the duties of the member. Okay, if it's services that is normal duty of the member, plus they are the part of the duties that the member must exercise for religious order as an agent. Okay, so it's like the normal job, the normal duty is performing those services. Okay, then in that case it will not be included in the income. All right, next is military pay. If you're working for if you're a military employee, not an employee, but if you're working in the military, then in that case you have to report the payment received as a service member as a wages for tax purpose. Okay, whatever amount you're receiving as an income, it will be included as a wages for tax purpose. Means what? Social Security, Medicare will be deducted. Okay, except for the retirement pay, which is taxable as a pension. If you receive a retirement pay from the military organization, then in that case it will be treated as a pension. All right, next is interest income. Okay, so right now we have done with only first part, that is related to the wages, right? Yesterday we completed all these topics. Tip income, if the employee is receiving stock option, restricted property, group term life insurance, everything we have covered yesterday. So let's see, only the first part is done. Second part is done, special rules for certain employees. Now let's look at the interest income. So if you have earned income, which means if you have earned interest income, then in that case how much will be taxable and how much will be exempt, and if it is taxable, then in which form, which schedule it will be shown. Let's see. Okay, yeah, here it is. Interest income is taxable if it is received on federal bonds. If it is received on state bonds, you can look see over there, it's received on the state bond or a local government bond, then it is exempt. It is non-taxable. Okay, but still it will be shown on your 1040 form. If you have seen the form, then you remember the taxable interest, taxable and exempt interest. Okay, so in the exempt interest column, this amount will be shown. Okay, taxable interest, interest on the federal bond, premium received on the opening bank account. Okay, and if that premium is maybe $10 or $20, right? If you receive an interest, of $10 or $20, right, and your balance is more than 5,000, then that interest is taxable. Okay, you receive some premium in opening the bank account, you deposit certain amount, and the balance at that time is $5,000, and you receive the premium or maybe interest on that opening bank account of $10, $20. Normally what happens, they give you discount. Say for example, you will be opening a bank account for say $5,500, and you need to just pay $5,490, and in your bank it will show you 5,000. So it's a discount they are going to provide you. So the discount provided is $10. Okay, and the balance is more than 5,000. So this discount which you're receiving will be considered as a interest income, and you are going to include it in your income. 1099 INT will be issued by the bank. Okay, and you are going to include it on your Schedule B. Okay, next is if interest on deferred payout arrangement is there. Now what do you mean by deferred payout arrangement? We have included here one example. Let's see. If let's say Mr. X dies, but his nominee gets the amount. Okay, now nominee has the option, they can opt to get let's say 1 million today, or they can just accumulate it for 20 years, and after 20 years instead of 1 million they'll receive 12 million. Got it, guys? Sorry, 1.2 million it is. So the 0.2 million that they're going to defer, right, that they're going to receive in future, that is nothing but a interest earnings, right? That amount will be included in the Schedule B. So interest on deferred payout arrangement will also be considered as an income and will be included on Schedule B as a interest income. All right, next is interest for seller financed mortgage. Let's say if I want to sell my property, but the buyer is not having enough money to buy that property, then what the buyer can do, what the seller can do, seller can provide them a opportunity to repay the amount in parts. Okay, so the interest for seller financed mortgage, seller is financing the mortgage for the buyer so that he can pay in parts, and that amount which they are going to receive it, right, it will be on a higher side. Obviously interest amount will be included in that total payment. Okay, so that will be taxable as a interest. Okay, second, non-taxable we have already seen, that is interest on state or local government bonds. Series EE bond means if you have a qualified bonds, if you have a bonds, you have redeemed that bonds and used it for the qualified purpose, that is higher educations. Okay, next is original issue discount. What do you mean by original issue discount? It's nothing but redeeming your bonds at a higher price, redeemed at a higher amount than purchased. So redemption value, which is I can say face value minus issue price. This difference is called your interest. Let's see whether this interest is taxable or not. To see that whether it's taxable or not, we have to do one calculation. What you need to do, take a redemption price, right, the face value, multiply it by 1%, multiply it by the number of years, let's say 20 years or 10 years is the life of that bond. So redemption, multiply 1%, multiply years, multiply 0.25. Okay, you will get one figure, you will get one amount. If your difference between the face value and the issue price, right, your discount, or I can say the benefit which you are getting is up to this amount, up to this calculated amount, then interest will be exempt. No need to include that interest in your Schedule B income. Okay, but if it's more than this amount, then what will happen? Capital gain will be charged at the time of maturity, and the interest will be includable as a taxable income in your Schedule B. All right, so this was all about interest income. Next is nominees interest. Okay, so now sometime what happened if some people are having account in joint. Okay, so joint saving account in the name of one taxpayer it is. They are going to receive 1099 INT. Okay, it's a joint account. Let's say Mr. A and Mr. B are having a joint account. Okay, and what happens? The bank issues 1099 INT in the name of Mr. A only. So is it fair to include the whole interest in Mr. A's tax return? No, because the benefit is received by both Mr. A and Mr. B. They are having a joint account, but the bank issue, that bank has issued only 1099 INT only in the name of Mr. A. So what happens? Joint saving account in the name of one joint saving account is there, but 1099 INT is received in the name of one taxpayer. Okay, so what that Mr. A will do, they are going to include full amount in the taxpayer's return as an inflow, and then Mr. A will issue a 1099 INT to Mr. B to exclude some interest portions. A 50% interest portion is there. So first he is going to include whole 100% as interest income, and for the 50% is going to issue 1099 INT to Mr. B. Okay, and Mr. B is going to include this 1099 INT in their income, and Mr. A is going to exclude the 50% which is related to the Mr. B. Got it, guys? Simple. Interest income is very simple. There is no complex question which are going to come from this topic. Just remember the exempt bond, that is interest on state or local government bond is exempt, and Series E bond is exempt. Okay, apart from that, anything which you receive in the name of the interest, wherever you receive a 1099 INT, you are going to include it in Schedule B. If you have already done the 1040 returns, right, you might have seen this. Okay, next is dividend income. Just like interest, for dividend we are going to receive a 1099 form, that is 1099 DIV you are going to receive. Okay, from the institution or organization who is paying you the dividend, and you are going to include it as a taxable dividend. Now there are four types of dividend. First is ordinary dividend, second is qualified dividend, third is non-taxable dividend, and fourth is capital gain distribution dividend. Okay, let's see what you mean by ordinary dividend. It's nothing but if you receive a cash or in-kind distribution out of the retained earnings of the profit of the company. Okay, company will be issuing you some amount as a dividend. Okay, so if you receive a cash or in kind, and those cash and in kind is from the retained earnings of the company, then that amount will be taxable as ordinary dividend in your tax return, and for that you are going to receive a 1099 DIV from the company. Okay, next is qualified dividend. If you receive a qualified dividend, then the tax rate is different, that is 10%, 15%, 20%. Okay, if the dividend is paid out by a US corporation or a qualified foreign corporation, plus if you're holding the stock, right, on which you're receiving the dividend, if you're holding that stock for more than 60 days out of 121 days starting from the 60 days previous to the ex-dividend date. Okay, so don't get confused. Let me explain it in a better way. If you receive a dividend over here, okay, just go back 60 days. From this date, you will calculate 121 days. Okay, now out of this 121 days, if you have held the stock for more than 60 days, then that stock is your qualified stock, and dividend received on this stock will be called as a qualified dividend. Got it, guys? Simple it is. Next is non-taxable tax-free dividend. If you receive something, some amount which is nothing but a return of capital up to the amount put in the company, Okay, like you receive a stock split or a stock dividend. Okay, and if you receive that up to the capital amount, whatever you have invested it up to that amount, if you're receiving it, it's a non-taxable and tax-free dividend. It's just simply a return of capital. Okay, fourth is capital gain distribution. Apart from that, whatever contribution you have made, over and above that, if you're receiving anything, okay, if the company pays back more than the face value, right, the difference between the face value and the amount of distribution will be called as a capital gain. Okay, let's say I have invested $100. For example, I have invested $100. Now company pays me $50 as a dividend, and that is not from my retained earnings. If it is from my retained earning, it's directly going to a taxable ordinary income or ordinary dividend. So this $15 is nothing but a return of capital, means it will be a non-taxable dividend, tax-free dividend. Now my balance is $50. Now company is going to issue me $90. Okay, so now right now my investments are 50, but company is going to provide me the $50. So the excess $40 will be charged as a capital gain. Okay, and the $50 is nothing but a return on capital and will be not taxable. Tax-free dividend, I can say. All right, guys. So this was all about dividend and other corporate distributions. Let's see, there are some plans which the corporation have. If it's a reinvestment plan, okay, FMV of additional stock will be reported as a dividend income. Okay, in reinvestment plan, what happens? Guys, what happens in reinvestment plan? FMV of additional stock is given to you, right? Whatever dividend you are going to receive, you're not going to actually receive it, but against that it is being added up in your as an additional stock, right? So FMV of additional stock will be reported as a dividend income. If you receive an additional stock in a reinvestment plan, you're going to report it as a dividend income. As simple it is. Next is amount received by mutual fund or REITs. Okay, real estate investment trust. If you receive any amount from mutual fund or those kind of trust, real estate investment trust, then it will be reported as LTCG always. Always you are going to report it as long-term capital gain, and the form for that is 2439, and schedule D will also be used. Okay, any amount received from the mutual fund and REITs. All right. Non-dividend distribution means nothing but up to the amount of basis, whatever amount you have contributed, okay, up to the amount of the basis, it is non-taxable. More than that basis, it will be taxable. What do you mean by basis? You know, right? Basis is nothing but the amount which you have initially contributed in the company, right, plus profits minus distributions. So plus and minus some adjustments, that will be your adjusted basis. Basis is nothing but whatever amount you have contributed in the company, right? The initial investment which you have made in the company is your basis. Okay, and it will be not taxable. Whatever distribution you receive will be not taxable, right, up to the basis amount. But if it's more than the basis, right now we saw, right, $50, $40 will be the excess, $90, the $40 is the excess, will be taxable, right? Stock and stock rights. If you receive a stock right only for common stock, then it's not taxable. Guys, there will be one MCQ from this, so make sure you're listening to it properly. If you receive stock right only for common stock, then it's not taxable. If the company gives the option, some are going to receive preferred stock, some are going to receive common stock, then the whole distribution will be taxable, the whole distribution. Okay, option is given either to get a preferred and common, the whole distribution is taxable. Half preferred, half common stock are provided to all the stockholders, then also the whole amount will be taxable. Only preferred stock is provided, then also it is taxable. Just remember only one thing: if you're going to receive a common stock, okay, then it is not taxable. All right, not taxable as a dividend. Apart from that, everything will be taxable. Okay, so that was all about dividend. Let's see next and most important topic. Almost 5 to 6 marks question comes from this topic. People used to get confused in this topic, but don't worry guys, we are going to learn it right now in a very smooth manner. Okay, IRA. If you have a retirement account, okay, this retirement account has some limits for contribution. Okay, $6,000, $7,000 is the limit of contribution. If your age is more than 50 years, then this is the maximum limit. Like up to 6,000, up to 7,000, you can, allocate, you can contribute in the retirement account. Okay. Now it can be any account. It can be a traditional IRA or it can be a Roth IRA. Okay. Cumulatively, the limit of contribution is 6,000 and 7,000. All right. I am going very slow, guys, so that you can understand this whole chart. It's very well designed over here. Okay. If I talk about traditional IRA, how much contribution is deductible? Okay. See, how much contribution you can make, that we have already seen, that is 6,000 and 7,000. Okay. So in traditional IRA contribution, there is no phase out. Directly you can do a 6,000 and 7,000 of the contribution. If you are a MFJ, right? If your filing status is MFJ, married filing jointly, then the contribution limit for 6,000 is doubled to 12,000. Okay, so per person it is 6,000. And if your age is more than 50, it will be 7,000. So if one spouse is age more than 50 and one is less than 50, then they can take a 7,000 plus 6,000, that is 13,000 as a deduction. All right. The whole amount for traditional IRA, the whole amount is deductible. Whole contribution is deductible. All right. Roth IRA. If I talk about the Roth IRA, whatever contribution you are making in the Roth IRA, this 6,000 and 7,000 will get phased out. Okay, phased out depending on your income. Means out of the 6,000 and 7,000, you can't make the whole 6,000 and 7,000 contribution. It is being phased out depending on the limit. So what are this limit? These are being changed for 2022. Okay, and these are as per the latest limits we have mentioned over here. MFJ, if your income is up to 2,04,000, then you can take the whole you can make the whole contribution, right? 6,000, 7,000, depending on your age. If your income increases, right, more than 2,04,000, but it is up to 2,14,000, then you need to phase it out. What do you mean by phase out? Nothing but out of the 6,000, the contribution will be limited to your income. Okay, so let's take example, your income is say 2,08,000. Okay, sorry for the zeros. Okay, if it's 2,08,000, then what you're going to do is, whatever is the difference between 2,04,000 and 2,08,000, that is 4,000, right? Divide by the lowest limit, that is 2,04,000. Okay, whatever is the amount. Okay, let's calculate the amount. Okay, so 4,000. Sorry, yeah, 4,000 divided by 2,04,000. It comes to 0.019 multiplied by 6,000. It will be 117. So 117 is phased out, means out of 6,000 you cannot take 117 of deduction, means maximum you cannot contribute $117. So maximum for Roth IRA which you can contribute is $5,882. Okay, in practical life you don't make this calculation. This everything is done by the software only, but for exam purpose you need to remember these limits. You need to understand how much maximum contribution can be making. Traditional is very simple, just go with 6,000, 7,000 limit. But if I talk about Roth IRA, the phase out limit will come into effect. Okay, the whole 6,000, 7,000 contribution is not allowed. Okay, you need to do a phase out calculation based on the limit. So if it's MFJ, you need to see whether the income is up to 2,04,000 or more than 2,04,000 or up to 2,14,000. MFS 0 to 10,000 is the limit. Single and HOH 1,29,000 to 1,44,000 is the limit. All right, guys. What are the consequences if you make excess contribution? So this was the limit of contribution. Over and above this, if you're making a contribution, what are the consequences? Okay, let's see. If the excess amount not withdrawn before 15th April or maybe extended time limit, that is 15th October, then you will have to pay excise tax at the rate 6% and it will be shown on the form 5329. Got it? That's why these limitations are there for the contribution. Okay. So over and above this, if you're making any contribution, you are going to pay a tax at the rate of 6% excise tax. See, the whole topic is very important, guys. I want you guys to go through this lecture again and again if you want, but understand it very carefully. Okay. If excess amount is withdrawn before 15th April or 15th October along with the earnings, right? Now, what do you mean by along with the earnings? Whenever you contribute to the IRA account, you might have some earnings on the balance, right? On the balance amount, if you receive some interest, some earnings are there on that balance. Along with that, if you're withdrawing, see, let's say I need to contribute $6,000, but I have contributed 7,000. So the 1,000 excess which I have contributed, I need to withdraw it. But instead of 1,000, I withdrew $2,000. So the 1,000 excess dollar which I have withdrawn, right, that is the excess earnings. On that excess earning, what will happen? If it's a traditional IRA, no tax will be there. But if it's a Roth IRA, then also no tax will be there. Okay. Excess amount, there will be no tax for traditional and for Roth. That 1,000 I'm talking about. Okay. The 1,000. Let's take other example. Let's say 6,000 needs to be contributed. You contributed 8,000. So 2,000 is your excess amount. But when you withdraw, you withdrawed $4,000. Okay. So out of this $4,000, the 2,000, okay, the 2,000 which was the excess contribution, on that amount there will be no tax. But on the excess 2,000 which you are withdrawing, excess like the earning which you are withdrawing, if it's a Roth IRA, then there will be no tax. But if it's a traditional IRA, then it will be included in your income. Plus, you are going to pay a tax on early withdrawal, a penalty I can say at the rate 10% on early withdrawal. So two effects will be there. All right, included in the income, and 10% penalty will be paid on the excess amount which you are withdrawing, right, apart from your contribution amount. All right. Next is deductible contribution. Now you know what is the limit of contribution, and if you make an excess contribution, what will be the consequences? You have to pay the excess tax of the 6%. And if you withdraw it before 15th April or 15th October, then there will be no tax. But along with that interest, along with that excess amount, if you're withdrawing any earnings from the IRA, then it will be taxable only in case of the traditional IRA, not in the Roth IRA. All right, this is about the contribution. Now let's see deductible contribution. Whatever amount you're contributing now, how much you're going to deduct it from your income, how much benefit you're going to get. If it's a Roth IRA, there will be no deduction in your AGI. In your adjustment to income, there will be no amount will be included if it's a Roth IRA. If it's a traditional IRA, guys, if it's a traditional IRA, the deduction are phased out for 6,000, 7,000. Again, the phase out limit will be there. Now, the deductible contribution limit is again bifurcated into two parts. If the taxpayer is covered by the retirement plan, right, wherever he is working, and like the employee, the taxpayer is an employee, if is covered by the retirement plan at work, or it's not covered by the retirement plan. Okay, so if it's not covered by the retirement plan, then in that case, what will happen? First, we are seeing that part. Okay, the limits are if you're a single or HOH or a qualifying surviving spouse. Okay, now the name has been changed to qualifying surviving spouse. There is no limit. You can contribute 6,000, 7,000 whole amount, whatever is your income. If you are MFJ or MFS, again, there's no limit. But if you're a MFJ and your spouse is covered, then the limit of 2,04,000 and 2,14,000 will apply over here. Okay. If you're a MFS and your spouse is covered, then up to 0 to 10,000 limit will be applied over here. Now you know the phase out calculation, right? Take the difference between the actual amount and the lower limit, okay, and then divide it by the lower limit and multiply it by the 6,000 and 7,000. That will be phased out. Means that much amount you can't take as a deduction. Got it, guys? If the taxpayer is covered by the retirement plan, okay, then the limits are different. If it's a single or HOH, it will be 68,000 up to 78,000. Over and above 78,000, $0 will be allowed. So remember why the maximum limit is given. If you go above that amount, $0 will be allowed as a deduction. MFJ or qualifying surviving spouse, okay, it will be $1,09,000 to $1,29,000. MFS, it's $0 to $10,000. Okay, simple it is. Deductible. So now you know what can be contributed. Okay, over here you know what can be contributed. Out of this contribution, how much can be deducted is shown over here. If it's a Roth, there will be no deduction allowed. See, when you do the tax returns now, this thing is automatically done by the software. But you should know the limit. If you are contributing in a traditional, IRA, right? You will be able to advise your client very well if you know the limits. Okay, whether the taxpayer is covered by the retirement plan or not covered by the retirement plan, you need to see that. Okay, and then the calculation will be done. So it's like if the client is making the contribution in a traditional IRA for say 5,000 or 4,000, you will be like, still why it's phasing out? Because of their income, because of the type of employee, if they are covered or not covered. Then the amount of deduction which you're going to see in the software will be totally different. Okay, so don't get confused that it is within 6,000, 7,000 limit, still why we are not getting the whole deduction, because of the income limitation, guys. Okay, whatever is non-deductible will increase the basis of IRA, and that amount will not be taxable when withdrawn. Okay, so let's say if you have contributed $6,000, but due to your income limitation, only $4,000 has been deducted. So the remaining 2,000, which is not deductible, will increase the basis. FMV is also asked in the software. So it will increase the value. It will increase the basis of the IRA account. And whenever you withdraw, right? Let's say if you're withdrawing $7,000, so out of that, the 2,000 which was added to the basis will not be taxable, but the remaining 5,000 will be considered for the tax purpose. Okay, we are coming to it. We are coming to the withdrawal part right now, but make sure you understand again. If you want, you can rewind and again understand what is the contribution, how much limit is there in the contribution. If you make excess contribution, what are the consequences? And if you have a deductible, like whatever contribution you are making, how much will be deductible from that contribution. Okay, next is qualified charitable distribution. See, if your IRA account, you are directly donating something to a charity, you're not taking the distribution, but you're directly distributing it to a charitable institution, right? Then it will be a non-taxable distribution made directly by the trustee of an IRA to an organization eligible to receive a tax deductible contribution. Means nothing but charitable organizations. Okay, and this is only for the traditional and Roth IRA. Taxpayer must have at least 70.5 years of age to take the qualified charitable distribution. If your age is less than 70.5 years, then it will not fall under non-taxable. It will fall under a taxable limit. Maximum how much you can distribute? $1 lakh if you're single or MFS. But if you're a MFJ, you can take, you can distribute up to $2 lakh from your IRA account, from a joint account. Okay, it will be reduced by deductible contribution for all taxable year after the taxpayer attains the age of 70.5. So see, once you attain the 70.5 years of age, you contributed to a charitable organization directly from your IRA account, let's say 50K. And then again in the next year, you contributed 50K. Again in the next year, you contributed 50K. Again, in the next year, you contributed 80K. So out of this 80K, only 50K is allowed because the total of 2 lakh is cumulative, right? All taxable year once you attain the age of 70.5 years. After that, whatever you are distributing for a charitable institution, right, directly up to 2 lakh, it is non-taxable, but this 2 lakh calculation is cumulative once you attain the age of 70.5. Got it, guys? Read it again, go through it again. Let's see. Now the important topic is distribution. Mainly the question comes from this topic, that is distribution. If you have a traditional IRA, right, and you make a distribution, it will be taxable. Why it is taxable? Because when you made the contribution, it was deductible, right? You took an adjustment to the income for traditional IRA contribution. Now, if you're having some distribution from the traditional IRA, it will be taxable. Initially, it was deductible. Now, it is taxable. Roth IRA. Initially, it was not deductible. Now, it will be not taxable. Simple rule it is. If it is deductible earlier and now you're taking the distribution, it will be taxable. If it is not deductible earlier and now you're taking the distribution, it will be not taxable. All right, understood, guys? Once you attain the age of 72 years, you are mandatorily required to take a required minimum distribution, that is RMD, required minimum distribution. Okay, if no required minimum distribution is taken by your side, then the IRS will consider as 50% excise tax on non-distributed amount. And again, for penalty, like on IRA, if you have any penalty, you have to file a form 5329. Okay. Now, what do you mean by early distribution? If you take a distribution before the age of 59.5 from your traditional, from your Roth, from your SCP or simple plans, okay, these are the type of retirement plans. So, any of the type of plans, if you're taking a distribution before reaching the age of 59.5, then you have to pay an additional tax penalty of 10% on the excess distribution. Like whatever distribution you have taken, flat 10% is a penalty which will be applicable. Okay. Simple IRA, if only for simple IRA, there will be one question from this topic. Simple IRA, if you're withdrawing within 2 years from the date of participation, then you will be liable for a 25% penalty and not 10%. Whatever is your date of formation of your simple IRA account, from that date, you have to maintain the whole amount for 2 years. Before 2 years, if you're withdrawing, then the penalty will increase to 25%. All right, guys. There are some exceptions. Okay, now there are some exceptions. In this case, the penalty of 10% and 25% will not apply. Okay, let's see. For a qualified IRA plan, qualified or IRA plan. What do you mean by qualified? The simple and SCP are a qualified plan. 401k plan are a qualified plan. Okay, for a qualified plan or IRA plan. IRA means what? Simple, traditional and Roth IRA. In that case, if the distributions are made to the beneficiaries or estate after death, let's say if Mr. X is a owner of an IRA account, IRA plan or a qualified plan, okay, and he dies, and whatever amount was outstanding on the IRA account is being distributed to his beneficiary, his estate after the death. So whatever distribution is being made, in that case, you are not going to look at the age criteria. Okay, the whole distribution will be exempt if the distribution is made in case of death. Okay, taxpayer is totally and permanently disabled, and at that time, if they are taking the distribution, then the 10% penalty will not be applicable. Okay, guys. Next is distribution made as a part of taxpayer's life expectancy by way of periodic payment, plus taxpayer must be separated from the employer, right? If you're working with one of the employer and now you've separated from the employer, and the payment which you are receiving from the IRA account is a fixed amount depending on the life expectancy. Periodic payment you are receiving, right, from your IRA account after separating yourself from the employer, right? Then in that case, the 10% penalty will not be applicable, whatever is your age. Okay. Next is if the distribution which you are taking is applied for medical purposes. Okay. For medical expense, if you are applying the distribution, then it is not taxable. But remember here the limit is medical expense minus 7.5%. 7.5% you get a deduction on your schedule A, right? 7.5% of AGI. So medical expense minus 7.5% of AGI. Up to this amount only the distribution should be. So whatever distribution you get, you are not going to pay additional 10% penalty. Okay. And this medical expense you can take a deduction on your schedule A. All right. Next is due to IRS levy of plan. Okay, so IRS may have some levy on your plan for non-payment of the taxes. Then in that case, the IRS can withdraw the whole amount. So you can't charge IRS the penalty of 10%, right? Next is qualified military reinvestment reservist distribution. If you are in the qualified military reservist, and that kind of distribution will be not taxable, not applicable for penalty of 10%. We are right now looking at non-applicability of the withdrawal plan penalty. Next is relating to certain federal emergencies and disasters, right? If certain areas are covered by the disasters, federally declared disasters, and up to 1 lakh if you are withdrawing, then you cannot, you don't have to pay the 10% penalty. Distribution of up to 5,000 if qualified birth or adoption distribution. Okay, if you are adopting a child, or there is a birth of a new child, and to that you are having a financial constraint, and for that you are withdrawing some amount from the IRA account, right? Then in that case, up to 5,000 you can withdraw without penalty. But there are 2 points: within 1 year of the date of birth or adoption you have to withdraw. Second is the person, like the child whom you are adopting, should have an age of up to 18 years, and each parent has the limit of $5,000, and each child has a limit of $5,000. Let's say we have adopted one child, and also in that year only we have a qualified birth of a new child. So you can take a $10,000 as a distribution from IRA. So $5,000 limit is per child, and per parent it is. Okay. Now next is if you are having only a qualified plan, if you are withdrawing something from that, then in that case, if the distributions are made after 55 years of age, okay, here limit is 59.5 years, but after 55 years of age, plus taxpayer is separated from the services, and if you're withdrawing it, then the 10% penalty will not be applicable. Distribution made from a qualified government plan if the taxpayer were a qualified public safety employee. Okay, there will be one MCQ from the second point. Okay, if the employee is a qualified public safety employee plus taxpayer reach the age of 50 years. Now here it is 50 years plus a qualified employee, government employee, public safety employee. The first point was regarding the 55 years plus the taxpayer is separated from the employee. Third is distribution to a alternate payee under QDRO, qualified distribution scheme. If you receive a distribution as a by way of alternate pay, you are an alternate payee, right? And you receive a distribution, the IRS can't come and tell you, so you need to pay the penalty of 10%, because it's an alternate pay. You are just an alternate pay, not the beneficiary, not the main owner. Okay. Next is distribution of dividend from employee stock option ownership plans. Okay. And the last is corrective distribution of excess contribution. If you have made an excess contribution in the traditional or Roth IRA, and if you're withdrawing it before 15th April or 15th October, there is no rule that you need to pay a penalty of 10%. You're just improving that, reversing that thing, okay, which was made wrong earlier. Next is for IRA only. For IRA only means for traditional and Roth IRA. And for qualified plan, this was about only for qualified plan. This was only for IRA, and this is for both. Okay. If you are a first time home buyer, and you are withdrawing amount of 10,000 up to 10,000 per spouse. Okay, so both are if withdrawing, then it will be a 20,000 reduction they can take. Distribution for a qualified higher education if you are taking from an IRA plan. Third is distribution for health insurance premium paid while unemployed. If you're unemployed and if you want to pay the health insurance plan, okay, then you can take a distribution without paying any penalty. Fourth is returned IRA contribution if withdrawn extended by the due date. Simply, it is the same thing, corrective distribution of the excess contribution. This is for IRA. Now, only for Roth IRA, distribution is made after 5 years from the date of contribution plus made after 59.5 years, or home buyer up to $10,000. Okay. Qualified education expense, qualified health insurance expense, or returned IRA. All right. So in case of Roth, just specific, I'll tell you one thing. This Roth is important. The second point is important. And one more thing was important. If you withdraw before 2 years, yeah, this one is important. So there will be 3 questions from this 3 topic that I'm telling you. Okay. So go through the IRA topic and don't forget to go through these points. See, I still remember on the day of exam, my exam was in the afternoon. Okay, I took the second slot and the IRA was so confusing, so confusing. I prepared this chart in the morning, in the 6 a.m. on the exam day, I have prepared this chart. Okay, so you guys don't confuse yourself. Just go through, the charts which are already available for you guys, ready-made, before going to exam. You don't have to go through the theory. Just go through the IRA topic in a very well manner from this chart. Okay, just remember this third page is very important. Whatever distribution, they'll list you the type of distributions and you have to guess, right? You have to apply your mind that whether the penalty of 10% will be applicable or not on this distribution. Okay. Next is, if there is a distribution due to death and the distribution is made to a surviving spouse, then treat as their own IRA by rolling it over to the own account. You're not going to tax the surviving spouse. The surviving spouse is going to roll over the whole amount from the IRA of the spouse whose death has been like there is a death and then distribution is made to the spouse. So the whole amount will be rolled over to the other account in the name of the spouse. If you're other beneficiaries apart from the spouse, you must withdraw the entire balance of the retirement account within 10 years. Within 10 years, you have to withdraw it. Only the spouse has the benefit to roll it over to their own account. But if you are other than the spouse, if you're a child or a grandchild or any XYZ beneficiary, you cannot roll it over in your name, right? You need to withdraw it within 10 years. What are the method of distribution? You can take a lump sum withdrawal. You can take a life expectancy distribution, right? You can take a 5-year deferral plan, 5 years deferral plan, and then you can withdraw with the benefits. And that interest amount which you have earned excess will be chargeable as a 1099 IND interest. Right now only we saw about the 1099 IND, right? Exception for 10 years. If you're a surviving spouse, you don't need to withdraw it within 10 years. The child of the account owner who has not reached the age of majority, right? After 10 years also, you are still minor. You cannot withdraw the whole amount. A disabled or a chronologically ill person is there, right? They don't have the a mandatory rule to withdraw it within 10 years. A person not more than 10 years younger than the IRA account owner. Okay, person who is not more than 10 years younger than the IRA account owner, they can't withdraw it within 10 years, right? Next is annuities. So along with the IRA, we come along annuities and the pension. Okay, the both will be read together. Annuities, if you receive this, receive the same tax treatment as a qualified and IRA. Qualified IRA, whatever we read right now over here, the same tax treatment will be there for the annuities. There are 2 types of annuities. One is annuitization and second is exchanges. One is annuitization, converting an annuity into the series of a periodic payment. Okay, so you are going to receive the payments in a series. Okay, First is accumulation phase, and then there is a distribution phase. You're going to, put some contribution, put some amount each month, each year in your plan. And then that phase is called your accumulation phase. Prior to annuitization, withdrawals are removed, earnings first, right? The IRS treats any amount in excess of the basis as an ordinary income. Then there's a distribution plan. Whatever amount you're going to get as a distribution, periodic payment, right, will be excluded according to the ratio. Let's look at the examples. Let's say Mr. X spends $1 lakh for immediate annuity. The insurance company will pay Mr. X a $500 each month for next 20 years. Okay, accumulation has been done. That is $1 lakh is the accumulated amount. Each month, the person is going to receive $500, that too for next 20 years. So that is a distribution phase. So the tax-free portion of each payment will be 416.67. How you did it? See, 20 years multiplied by 12 months. So each month, like I can say 240 month. 240 months, so 1 lakh, the base amount. See, the initial investment amount is not taxable. So what you will do, 1 lakh divided by 240, this much amount is a tax-free portion. So out of 500, 416.67 is a tax-free. Over and above that will be a taxable distribution in case of annuity. Okay. So this was about annuitization. Next is exchanges. During the accumulation phase, a policy holder may exchange an annuity under IRC section 1035 for a policy with other provider without recognition of taxes. Okay, so this is just the exchange of the policy. Annuity policy has been exchanged by one policy holder with the other provider. Okay, Mr. A, say A LLC is also insurance provider, B LLC is also an insurance provider. So they take out the whole annuity from A and exchange it with B LLC. Then in that case, it's also a not taxable. This was about the annuities. Okay. Now let's see, there are some prohibited transactions. Okay. In case of IRA, between the plan and the taxpayer or the beneficiaries and the disqualified person, if there are some exchanges or if there are some transactions happening, then that is a that is prohibited, that is not allowed. Okay. Act of fiduciary who deals with the plan asset or income for his own interest. Okay, so that is a prohibited transaction. Transfer or use of plan asset or income for the benefit of disqualified person. We'll see what is disqualified person over here. So if you're using those plan asset for the benefit of disqualified person, then that is a prohibited transaction. Receipt of consideration by fiduciary in his own account. Receiving unreasonable compensation for managing the plan, and any act between the plan and a disqualified person of selling and exchanging or leasing of the property, lending money or extending the credits, furnishing the goods or service or facilities. Okay, so between the disqualified person, if you are entering into any of the transactions which are mentioned over here, means which are prohibited, you will have to pay 15% of tax. And if you're not paying the penalty of this 15%, the whole 100% of the amount involved will be liable as a penalty for you guys. Okay, so make sure you're not entering any transaction with a disqualified person. What do you mean by disqualified person? Here we have mentioned fiduciary plus any of his related person, XYZ, any related person. Person providing services to the plan will be considered as a disqualified person, or any of his related person. Employer, if any of his employees covered by the plan. Employee organization, if any of the members are covered by the plan. Employee plus employee. No need to remember the list. Just understand if any transaction is this type of transaction. Remember the transactions. If any of these transactions are entered with the disqualified person, which are mentioned here, then you need to pay a tax, a penalty of 15%. Okay. What is the early withdrawal penalty, guys? We have learned it right now only. What is the early withdrawal penalty? Don't get confused. It's 10%. And if you do a prohibited transaction, then in that case, it is a 15%. Okay, guys. Pension annuity for a non-qualified deferred compensation plan or a non-government section 457 plan are not reported on schedule 1 line 8T. Okay, if you've seen the 2022 form, right, the 1040 form, it has been amended, and line 8T, many lines are added on the first page of the 1040. So out of that, on line 8T, it is not reported. Okay. Next is social security benefit. This is very simple topic, guys. Don't have to get confused yourself by solving the question. Just bifurcate the whole question in these three parts. First is provisional income, second is base amount, third is adjusted base amount. Provisional income is nothing but AGI plus tax exempt income plus your foreign income plus 50% of social security. Whatever is your social security benefit, take the 50% of it and add it in the three incomes. AGI, we are going to add a tax exempt income. Why? In AGI, the tax exempt income is excluded. That's why we are going to add it. Foreign income is also excluded. That's why we are going to add it again, plus 50% of the social security benefit. That is your provisional income. So first part of your question is done. Next is you're going to see what kind of taxpayer it is. If it's MFJ or MFS or others, then you'll just note down the base amount. For MFJ, it is 32,000. For others, it is 25,000. And if you're an MFS, it will be $0. All right. Next is adjusted base amount. What you will do, you will take the base amount, that is 32 and 25, and you're going to add 12,000, 9,000. If you're an MFJ, you'll add 12,000. Any other taxpayer, you're going to add 9,000. So this is your adjusted base amount. Now three parts you know. Now just put this amounts in this table. If your provisional income, right, your provisional income is less than the base amount or maybe equal to the base amount, then the social security benefit, like taxable, what will be your taxable, what will be included in your gross income will be 0%. Got it? First, see, this is a very simple calculation which you can apply in your exams while solving the MCQs. Just make three parts. Take provisional income, take base amount, take adjusted base amount, and just check whether the provisional income is, that is the first one, is less than or equal to the second one. Okay, if yes, then 0% will be taxable. Not only this, it should also be less than the adjusted base amount. If yes, if your provisional income is less than the base amount, less than the adjusted base amount, only 50% of your social security benefit will be taxable. Okay, but if your provisional income is more than the adjusted base amount, then 85% will be taxable. Okay, guys, understood? Social security benefit is very simple. Just make three parts. Social security benefit, take 50%, add foreign income, add tax exempt income, right, and add it to the AGI. That is your provisional income. Second part is nothing but the base amount, which is a limit provided by the IRS. If you are filing as MFJ, the limit is $32,000. Others is 25,000. MFS is 0. Now you add some more limit to it. It will be a adjusted base amount, ABA, that is adjusted base amount. Add 12,000 and 9,000 to the base amount, that is 32 and 25. Okay, it will be 44 over here. Okay, if I add 32 plus 12, it will be 44. If I add 25 plus 9, 34, I guess, right? Yeah, 34,000. So if your provisional income is up to the 32 and 25, right, and also up to, see, it's a common logic. If it's up to 25 and 32 and 25, then it is obviously not going to exit 34 and 44K, right? Then you're not going to charge anything. Like 0% will be taxable as a social security, like taxable social security benefit. But if your provisional income is more than the adjusted basis, it's more than 44K and 34K, then you're going to charge 85%. Okay, and if it's less than the adjusted base income and less than this also amount, it will be 50%. All right, so just apply this whole diagram in while solving the question. You'll able to get the answers very quickly. Next is rental income and expense. It's nothing but a passive income which will be shown on your schedule E 1040 schedule 1. Okay, you have to take all the gross rental income, you will take all the prepaid rental income, which is, or maybe non-refundable deposits if you have received from the as a rental income, you are going to add it to the gross rental income. Add improvements. See, if the tenant is making some improvements, right, and on your behalf, the owner's behalf, they are making some improvement, they have done some painting work, right, at their like renovation work they have done, and they are not paid the rent. They said that I have done the renovation, I'm not going to pay 1 month rent. So whatever is the renovation amount, improvement amount which has been paid by the tenant will be added in your rental income. Okay, any amount received from tenant which should be paid by the taxpayer, let's say municipal taxes or maybe property taxes, which needs to be paid by the taxpayer but is paid by the tenant, so that will be also added as a rental income. You will reduce all the rental expenses like utility expenses or maybe XYZ expenses which you have incurred, right, for renting the house. So you're going to reduce it, that is your rental expense. You're going to add all your incomes, the rental incomes, you're going to reduce your rental expense, that will be your net rental income or loss, and can be offset against passive income only. Now you know what is passive income, right, where your personal involvement is not there, that is a passive income. Your W2 wages, it's your active income, it's not your passive income, right? Dividend income, it's a passive. Interest income is a passive. Rental income is a passive. Business income, right? You're owning the business, you're doing it, you're 100% participating in that business. That is your business income and it's your active, not your passive. Okay. Rent of vacation home. If you have a vacation home and if you have rented it for less than 15 days, right, then regard it as a deemed personal property. All right. No rental income, no taxes, no deduction for depreciation or any expense will be allowed. If you have rented for less than 15 days, then it will be a deemed personal property. You're not going to consider, you're not going to tax at all any rent, and you're not going to take any deduction. But only the deduction which you can take is municipal taxes, mortgage interest expense, and those two expense will be allowed on your schedule A. All right, guys. Now, if the property has been rented for more than 15 days, there will be one question from this topic, I remember. If the property has been rented for more than 15 days, okay, and it is also used for personal purpose for more than 14 days or more than 10% of the rented days. Read it again, guys. If it has been rented for more than 15 days and it is used for personal purpose for more than 14 days or more than 10% of the total rented days. Okay, so let's say I have rented the property for say 360 days. I'll take a 10% of this 360 days, that is 36 days. If I've used the property for personal use, right, more than 36 days, right, or more than 14 days, if yes, then it will be considered as a deemed personal cum rental property, and then you have to bifurcate it between the personal use days and the rented use days. Whatever is related to the rented use days, that will be allowed as a deduction. Whatever is the personal use days, will apply this concept. We are not going to take any deduction for those proportionate amount. Only the municipal taxes, mortgage interest are allowed on schedule A. All right, this was about rent of vacation home. What can be the rental expense? It's nothing but insurance premium which is paid in advance, right? And in advance, if it is paid, it is not deductible. Cost of repair, it is deductible. Improvements or expense that increase the value of the property, and we'll apply the de minimis safe harbor rule. If your expense are up to $2,500, right, then you don't have to include you just have to include it as a rental expense. If it is above more than $2,500, then you are not going to include it in the rental expense, but you are going to capitalize it. Okay, this is a de minimis rule. Second rule is cost of improvement. If it's more than $200, then you're going to rent second option is $200.25. See, some people follow a different rule over here. Instead of this 2500, there can be a 5000 if you're filing a AFS, annual filing statement, financial statement, you're filing with IRS. Then instead of 2500, you can follow the rule of $5,000 as a de minimis. And that will not be deductible, but it will be capitalized and added to the cost of the asset. All right, guys. Next is rental activity loss, set off against only passive income. So if you are incurring the loss, then you are going to set off against only passive income. And if you are incurring a loss, and if that is up to 25,000, and if the criteria is fulfilled, which criteria? More than 50% of the work is involved in real property trade or business, okay, and the participation is more than 750 hours, then in that case you can get a rental loss deduction of up to 25,000 from your business income. Generally it is allowed only against your passive income only, okay, but if you are incurring a loss and that loss can be allowed up to 25,000 from your active income, I can say, okay, it will be allowed as a active income deduction against the active income as a deduction, okay. Set off, you can set it off basically. More than 50% involvement should be there, and more than 750 hours of participation should be there in the rental property. Now what happens if a person is having property A, B, C, D, E? This which property they are having, they are not going to bifurcate, they are not going to give 750 hours in each property. So in that case, there is one election that you can treat all the rental property as one unit, and for this unit only you have to see the 750 hours. Don't have to see it individually. Okay, so this will come in the practical scenario. If your modified AGI is up to 1 lakh, okay, then you get a maximum deduction from your ordinary income of 25,000. Remaining loss will be set off against the passive income, and if anything is remaining, you can carry it forward. But if your modified AGI is more than 1 lakh, what do you mean by modified AGI? AGI plus some tax exempt interest, right, and plus some foreign income. So that is your modified AGI. If it's more than 1 lakh, then the maximum deduction will be whatever is your ordinary income, right? From that, how much you can deduct is 50% of 1,50,000 minus actual modified AGI. Okay, if this we are doing phase out limit. Okay, so 1,50,000 minus Maggie multiplied by 50% or 25,000, that is our actual deduction. Whichever is lower, you can take it as a deduction from a set off it against the ordinary income, and the remaining loss against the passive income, and remaining if any will be carried forward. Okay. Now in current year, there are some standard mileage rates for miles driven in connection with your rental activities or business mileage rate. Next we are going to do business income, right? So rental activity or a business standard mileage rate are for 2022 tax year, it is from January 1st to 30th June, it is 58.5 cent a mile. So if you have driven let's say 1,000 miles, okay, if you have driven 1,000 miles in say first 6 months, and next 6 months you have driven 2,000 miles, so what the software does is 1,000 miles into 58.5 and 2,000 miles into 62.5 cent it is. Okay, so cent means nothing but 1 cent is equals to, sorry, $1 is equals to 100 cents. So 0.585 you are multiplying, and 0.625 you are going to multiply it. Okay, so this is how you are going to take the deduction. Next is business income and loss. Gross business income, you will take whole whatever income you are earning, you will reduce all the business expense. So that is your profit and loss from the business. The taxpayer will pay a federal income tax and a self-employment tax on this business income. Okay, and it can be offset. See, if there is a loss in the schedule C in the business income, then it can be offset against ordinary income as well. There is no rule like rental income, right? Rental loss, if you have, you need to compulsory offset against passive income only. But if I talk about the business income, there is no rule to offset this loss against only active. It can be set off against any income. It can be against salaries, dividends, or rental, or any income. It can be offset, okay, but not against the passive activity income, only active. Next is always use accrual method for reporting inventory. If you are using a schedule C and if you have an inventory in your profit and loss, in your business, if you're having inventory, then in that case always you're going to report all the incomes and expense on accrual method. Okay, now let's say if you have a business loss, then in that case the business loss limitation rule will apply. You'll have to follow a sequence. That is, first you are going to allocate the business loss on tax basis, then at risk basis, and then passive activity loss, and then business loss limitation. Okay, and NOL rule will apply, means general rule is that general rule is that you need to carry forward the net operating loss, and whatever business loss limitation will apply directly after that. Net operating loss, business loss limitation, simple it is. What is tax basis? Whatever amount you are bringing in the business, up to that amount you can set off, first set off up to that amount. Next, at risk basis, whatever loan or any amount you have taken to run the business, that amount, for that amount you are at risk. So second is at risk. Third is passive activity loss limitation you can apply. Okay, and the fourth is business loss limitation. Whatever is remaining, you can just offset against ordinary income and carry it forward. Okay, next is NOL rule. General rule is carry forward indefinitely, but second rule is business loss limitation rule apply. How much is allowed? If you have having a net operating loss, it will be allowed for a single, if you are a single filing status, the amount of deduction of business loss is up to 2,62,000. 262,000 you can deduct. If you are a MFJ, you can deduct 524,000. Okay, and the remaining will be carried forward. This can be against passive income if the loss is related to passive activity, and this can be set off against ordinary income if loss is not related to the passive activity. Okay guys, NOL rule is done. Yeah, here it is explained very well. For business loss limitation rule, you first have to apply for the tax basis. It is nothing but the cash property that you put into the business. That is your tax basis. Next is at risk basis, means amount you borrowed or gave a personal guarantee, right? Means you are at risk for that amount. Next is passive activity loss, not actively participating in the partnership or the S corp. That is your passive activity loss. You can offset. Third one is the third one you can offset. If there is any passive activity, then you can offset, or else you can move to the next one. Next one is business loss limitation, wherein if you're having a passive rental, offset it against that, or active, then offset it against any other income. Okay, now let's see about the carry forward rule. There are some changes since 2020. There are some changes in this. If you have a business loss that is related to before 2018, you can carry back that 2018 losses for 2 years, carry it forward for 20 years. Overall limitation for dollar was there, that only this much amount can be carried back and carry forward. Don't need to remember this. Maximum set off in the year of carry forward is not applicable. See, later on, maximum set off is applicable. If you see the 2020 chart, you will see, but we'll go stepwise manner. Okay, if the loss is related to 2018, you can carry back that loss for 2 years. If the loss is related to 2018, 2019, 2020, you can carry it back for 5 years. After 2020, any loss cannot be carried back. I'm talking about business only, right? Capital loss is allowed to be carried back. I'm talking about just the business loss over here. Okay, after 2020, no carry back rule is allowed, only carry forward you can do. Before 2018, the carry forward was allowed only for 20 years. After that, it gets lapsed. 2018, 2019, 2020, and after 2020, now the carry forward is allowed for indefinite period. Okay, overall limitation was there earlier, Then in between 2018 to 2020, it was withdrawn, means not applicable. And after 2020, it is there. If you are a single or MFJ, you can take a overall limit, like overall deduction of 262,000, and MFJ, then it will be 524,000. How much you can offset? See, if you're carrying it forward, right, how much you can offset from the taxable year or from the taxable income of that year? 100% if you the loss is related to 2018, 19 and 2020. But if the loss is related to after the 2020 tax year, then only 80% can be offset from the taxable year in which you're carrying it forward. Rest 20% will again be carried forward to the next years. Got it? So first, the oldest loss you have to first offset and then move forward. Additional income means apart from whatever right now we have learned, apart from that, if you have received any income, which is any refund of a state and local income tax, that is your additional income. Alimony received, other income, unemployment benefits, and other gains. Let's look into the detail. First is refund of state and local income tax. Okay, SALT we call it basically. So if you receive a refund of any state and local income tax which you have paid, the taxpayer who itemized a deduction may claim a deduction for state and local income taxes paid. Now you are receiving the refund for those for which you have already taken the deduction. Then in that case, if the amount affects the prior income tax, then report the refund as additional income on Schedule 1. Okay, if the amount does not affect the prior income tax, then you can exclude the refund from the income. If in the year the taxpayer paid the tax, right, the taxpayer either didn't itemize the deduction, okay, they took the standard deduction, so they didn't took the deduction for the state and local income taxes paid, okay, or elected to deduct the state and general sales tax instead of state and local. See, if you guys are aware about this rule, you can't take both the deduction. Either you can take local general sales tax, or wait, either you can take SALT. Okay, what is SALT? State and local income tax. Or you can take a state and local general sales tax. You can take both. Okay, so instead of SALT you took this deduction, or second thing, you instead of itemizing your deduction, you take a standard deduction. So initially you have not taken the deduction and now you are receiving the refund, you don't have to include it in the income. As simple it is. But initially if you have taken the deduction and now if you are receiving a refund, you have to include it in your income as by way of additional income. Okay, you will receive a 1099G of any refund received from the governments. Next is alimony. If you are receiving the alimony and if the agreement is executed in 2018 or earlier, all right, then it is a tax deductible for the payer and taxable for the receiver. Agreement executed after 2018, there is no concept of deduction and including it in the income. Just have to check the agreement date, which agreement date it is. Okay, next is other income. In other income, you might receive bartering income, bribes and kickbacks, gambling, illegal activities, cancel debt, prizes. Okay, you have a jury duty pay, rental or personal property, hobby income, court awards and damages. So this much are the types of other income which you can receive, and straightforward you are going to include everything in your additional income. Okay, so bartering income, report the fair market value. So if I am giving this phone, against this phone I am receiving the other phone. Okay, so that is a bartering income. So what we are going to do is we're just going to calculate the FMV of the property or services which we receive in bartering as an income at the time of exchange. At the time of exchange, we just see what is the FMV of both and we are going to include it in the income. Okay, next is bribes and kickbacks. Include an income on Schedule 1 as other income, or Schedule C if from a self-employed activity. Okay, bribes are not illegal, right? They are not allowed. So if you receive anything, you have to include it in other income, or if in self-employed activity in Schedule C, you'll have to include it. Next is gambling winnings. It's nothing but you will have to include it as a income. W2G form you're going to receive, and that form will mention the amount of income which you have earned from the gambling activities, that you're going to include it on your income. And if there is a loss, right, if there's a gambling loss, then you are going to take it as an itemized deduction only up to the amount of income which you have included, right? You have included the income of, let's say, 100k dollars, right? And if you have a loss of, say, 200k, you cannot deduct whole 200k, you can only deduct 100k, means only up to the amount of the income which you have earned. Illegal activities, if you have earned anything from the illegal activities, you have to include it in other income. Prizes and awards, if you receive, then it must be included in the income. If the taxpayer refuses to accept the prize, it must not be included in the income. Okay. Cancelled debt. If you have a debt, okay, if you have some payments which are outstanding, and if the bank cancels the debt or any other person cancels the debt, then you'll have to include it in the income. If the debtor must report the cancelled debt or forgiven amount as an income. So, for example, if I have outstanding loan and the bank says that your debt has been cancelled, then for me it's a benefit. I'll be including it as an income. A debt included, debt will include any indebtedness for which the taxpayer is liable or which attaches to the property held by the taxpayer. Okay, so this two kind of amounts will be included in the income. When it will be excluded, if the debt is cancelled, when it will be excluded, if the creditor intends to cancel the debt as a gift or bequest, the debtor does not have to report it as a income. Got it? As a gift, it's getting cancelled, then you're not going to include it in the income. Next is jury duty pay. If you receive any duty pay as a jury, then you'll have to include it in the income on schedule 1 as other income. Rental of a personal property, right? If personal property, if you're renting it out, if the taxpayer engages in the rental for the profit but is not in the business of renting, right, you will have to include it as a other income. If it's a business of the renting, then it will directly go to the schedule C or schedule E. Okay. Hobby income, people engage in the hobby for sports or recreational activities and not for making the profit. Okay, then in that case, except for certain horse related activities, the IRS presumes an activity is carried on for profit if it produces profit for at least 3 years out of the 5 tax year, including the current year. Okay. Hobby expense is not deductible. Hobby income will be reported on schedule 1, that is other income, obviously. Got it, guys? If you are under any recreational activities, means you're not making any profit, and if you're not making any profit for at least 3 years out of the 5 tax year, including the current year, then it will be considered as a hobby income, and in that case expenses are not deductible but income is taxable as other income. Okay. Next is court award and damages, important one. You have to include the following things as an ordinary income. If you receive any interest on any award, if you receive a compensation for lost wages or lost profits in most cases, punitive damages, right, punishments if you have have to pay, and the person who is receiving the punitive damages, right, physical injury or sickness, they will have to include it as a other income if they are receiving by the court orders or anything. Back pay and damages for emotional distress until under the Title 7 of the Civil Rights Act 1964. Attorney fees and the cost where the underlying recovery is included in the gross. Okay. Damages for one of the following, that is patent copyright damages, breach of contract, interference with the business operations. So if you are being awarded by the court orders, right, and you receive this amount, receive it as a damages amount, you'll have to include as other income on your schedule 1. Okay. Next is unemployment benefit. If you receive a 1099G, certain government payments showing the amount of unemployment compensation, you'll have to basically include it in the income. Other gain or loss, apart from this, when you have a 4797 form, you'll have to report it if there is any sales or exchange of business property, right? So for that, you'll use 4797 form. Some of the gains on form 4797 are reported on schedule D as a long-term capital gain, while other gains are ordinary and reported as other income, other gain and losses on directly on schedule 1. Okay, so this all are the type of incomes which we have completed today, and I hope you guys just go and revise the whole topic, solve the MCQs for the whole topic, then only move to the next topic. So in the next session, upcoming session, we are going to start with the income exclusion, and which is most important chapter. Almost I can say 10 to 12 questions can be asked from this chapter. So the income chapter is done. Next is income exclusion. So yeah, that's it for the day. If you guys want, you can just rewind it, just go through the topic again, because almost all the important topics we have covered today. So yeah, that's it for the day. Thank you guys. We'll meet again soon in the next session. Have a great day.